Hey, hello everyone. Good afternoon. Welcome you all. We are glad you are here for our webinar on the topic Integrating IBP and Financial Planning, Making Supply Chain a Driver of Business Performance. My name is Sashma Best and I am a support officer for ASCI. This webinar will focus on some of the major points like how to connect financial and operational planning to accelerate decisions, practical steps to integrate finance into IBP, how to alignment increase, how this alignment increases resilience and performance in volatile markets. So today we are joined by Massimo Giannato. He is a founder and managing director at Aleph Advisory. Massimo is an international advisor and he has experience more than 20 years in supply chain, finance, and strategy. He has led major planning transformation at DuPont and ExxonMobil and supports global clients in building decision-ready organizations. He is a recognized expert in integrated business planning and financial planning integration. With extensive international experience, he regularly supports organizations in aligning planning and decision making to drive resilience and performance. So, this is a fantastic opportunity to learn from this session. Please ask questions and share your own experiences. So, before we begin, let's review a few house rules to ensure everyone has a positive and productive experience. If you have any questions or comments, please use the Q&A box at the bottom of your Zoom window. You can see it at the bottom of your Zoom window. You can use that Q&A box to raise your questions or comments. All the questions will be answered either the during of the presentation or by the end of the presentations. If in case we run sort of time, then we can answer your questions through the emails as well, but we will try to complete and answer all the questions here only. This webinar will be recorded and we will upload the recordings to our YouTube channel after the webinar. So we appreciate and I hope you enjoy the webinar. We really appreciate your cooperation and support. I want to thank you all for joining us today. Now I will hand it over to Massimo to start. So thank you so much, Massimo, for giving us your time today. Over to you now.
Thank you, Sushma. Thank you for the kind introduction. So, good afternoon, everybody. It's a great pleasure for me to hear. So, I want to thank the ASCI for the kind invitation and opportunity to make this presentation. As Sushma mentioned, the topic for today is going through a kind of a roadmap how to integrate IBP and financial planning, which is becoming a more and more pressing need for global organizations that wants to have a cohesive and coherent planning work stream within the organization. But my idea for today is really to go through a journey, starting by understanding why this is a need today. The agenda for today is going to be basically a little bit longer. We're going to have a kind setting the scene, as I was mentioning, why we need this today, understanding what is the disconnect. So what a silo planning look like, which is a situation that most organizations face when they start the journey. An overview of what's an integrated model between IBP and finance. The core of the presentation this morning, actually this afternoon, sorry, will be a practical roadmap. So I really want to give you some hints that you can start using in your organization starting tomorrow. And have an overview of what's the average value delivered when you have a mature system. And then we wrap up and we open for Q&A. Just before diving into this for Q&A, I'll try to address questions on the go. If there's anything specifically that needs some deep dive, I will rather keep it for the end in order to make sure we are on time for the delivery of that. That being said, that Sushma already introduced myself. Quick overview. Got a background in. I started my career in finance, actually in financial planning. Then went in strategy, then in business planning. More than 20 years. Work most organizations like DuPont, Next Nobel. I was a consulting at the beginning of my career, and I'm really passionate about what I mean, turning uncertainty to strategy. Now, QR code is my LinkedIn profile. Feel free to connect. I'll be happy to stay in touch and to keep discussion going after this session. Let's start. Let's start with we setting the scene with the background. The title I chose is Why Volatility Demands a New Approach. You will agree that over the last few years, we witness a significant change in the dynamic of the value chains globally. The disruption that were in the past were limited to a region, an area. In the recent years, and we'll see how, start to have a global impact. So when I have to choose an image, which is a plastic representation of what that means, that what came in my mind. So you might remember that. It's a Ever Giver, the ship that in March 2021 blocked the Suez Canal for 6 days. This little event by itself was a very minor event, had a big impact on the global trade. I put here a summary of what meant for the global trade, for the Canal Organization, for Egypt itself. It was 2% of the GDP national. So that small event causes a big impact globally. But that's not one-off. That's just one example of multiple events that happened over the last few years that had global impact. This is a chart that I particularly like. I'm not sure how many of you are familiar with that. This is the Global Supply Chain Pressure Index, which is developed. It's odd enough, but it's developed by the Federal Reserve, the central bank of the US from the New York office. And that measure the pressure global supply chains undergo. If you look at the timeline of the horizontal axis, we're looking at 25 years. So that includes major events over the past. That includes 9/11, the big financial crisis of 2007, 2008. But you'll see that until the pandemic, all the impact had plus or minus one standard deviation from average value. So it was kind of contained. Starting the pandemic, you can see a huge swing, and it didn't start with the pandemic. It got even bigger with the obstruction, and then the invasion of Russia of Ukraine, and then the Red Sea crisis, and the trade tension where we see over the last few months. What does it mean? It means that as value chain become more and more interconnected, any single impact in one region has a global effect, so it has a multiplier effect. So the volatility now is really the new norm. And in order to face this, organization has to start changing the way they plan and changing the way they react. They should stop being reactive. They should really start being proactive, because the next disruption is really around the corner. Let me go because it doesn't move here. Okay, so let's start with initial situation. So if we look, this is the macroeconomic overview. If you look what means for a standard organization that starts the journey, on average, the usual sign of planning, which is silo, which is not integrated, but you got multiple work streams that they don't talk to each other, is a fragmented process between demand and supply chain, a disconnect between, let's say, the business or the sales-driven plans and the financial output process, which normally runs on its own. You got normally multiple tools and systems, maybe for legacy acquisition that don't talk or they're not fully integrated between each other. A silo decision making process between business and supply chain, finance mostly, supporting partially the business decision. And then normally what I saw is a lack of clarity or even duplication of role. That's the starting point of the journey. If you look at the other side of the spectrum, and if we start looking at what's the ambition when you have an integrated planning mature framework, you go really to where you want to be. So you got integrated cross-functional planning, but not longer fragmented. You got an aligned plan, one plan, and we'll see what means having one set of plans. As much as possible, automated process. Everybody's talking about buzzword of AI, but there are few opportunities like agentic AI that really can support the process and automate, and having the people focus, really value-adding roles, and now in scenario planning, which is paramount in this uncertain environment. So you really see starting point versus what class A, what best look like. The disconnect. Let me just go here. So let me just give me a sec here. Okay. Disconnect, especially between finance and supply chain, is meant because we normally look at different set of uh, target, KPIs, timing. So finance on one way, they focus on annual budget. That's the primary thing they want to do. Business finance mostly, they want to look how next year looks like. The quarterly forecast, so they want to have forecasts mostly on quarterly, sometimes on monthly basis, focus on financial KPIs. And then the time horizon is mostly for what I call external accountability. Normally, the finance team is the one talking to the market, so analysts they expect a given performance by organization. So it's mostly outward oriented rather than internal oriented for operational agility. Supply chain, on the contrary, has a completely different approach. Multi-cycle, concentrated on capacity, service level, inventory, so really on operational standard. The KPIs reflect this approach, and the horizon is much shorter. Normally, they focus on current month, probably next quarter when things look better, like the SNOE kind of approach. So there's a clear disconnect between the longer term finance horizon and the shorter term supply chain horizon. If these two pillars are not connected, integrated, then they clash. What's the evidence of this clash or misalignment? I put here three basically dimensions, which is what I just mentioned, the time frame. Mostly finance is longer term, is monthly, quarterly, annually. Supply chain is by default is monthly, is current month and maybe next month. Metrics completely different. Really financial metrics for finance clearly. We look at revenues, we look at the cost position, we look at profitability and cash. Supply chain looks at operational metrics. Probably the only commonality here will look at net working capital, what inventory means in terms of net working capital and balance sheet. That's where normally they meet at the beginning of the journey. And then the output. Output is the outlook, monthly, quarterly, yearly outlook, the budget for next year, while supply chain is mostly operational demand and supply. If that's the starting point, we need to start thinking, okay, what's the consequence in terms of the organization running and decision making? Well, you basically see three different areas. First of all, you got delays. If you really focused on having numbers that need to make sense and reconciling them between different work streams that are not integrated, that slow down critical decision because you spend more time in understanding if data is good enough rather than taking decision on limited data, which is going to be the rule of the game going forward. I remember I was in a session back in March on AI and finance, and one CFO of a major organization in Europe told me, I spend 80-90% of my time in reconciling number and only 10-15% on supporting decision making by the CEO rather than the other way around. And we're talking how AI could improve that. But delay in decision is the first real consequence of fragmented planning horizon. Secondly, as we just mentioned, the rework time. The organization, both in finance and in business, spent a huge amount of time in rebuilding the plan, understanding which are the assumptions, understanding what's wrong, and reconciling multiple numbers that end up from fragmented work stream. So you spend a lot of time reworking on data rather than taking decision based on those data. And that's what does mean in terms of market opportunity, mean missing market opportunities because you start having a reactive rather than proactive approach because you spend way too much time in understanding what your numbers tell you rather than taking decision on this. And then you basically act on the market when sometimes it's too late. So this is a snapshot of starting journey on, let's say, an organization which is way not mature. Let's look at what good looks like. What I present here is, I call it the three pillars of IP enablement. It's a summary of the best summary of the current best practices on the industry. Really put people, process, and tools because they resemble the three areas of interest and attention that an organization have to focus on when they want to start an IBP and integration planning journey. I always start with people because people is really the main enabler. If you don't tell people buy in, especially from a middle management, any process has a risk to stay on paper and is not a live framework. So it's really an exercise which is pointless. It doesn't help your organization get in maturity. What I list here is what I mean by people. You need to have for sure executive sponsorship. If your senior leadership doesn't sponsor it, it's very difficult to implement such a comprehensive framework like IBP or SLP or any else, XP&A. You need to have the key stakeholder buy-in involvement because those are the people that make the system live and the framework live. If they don't buy in this, again, the risk is that stays on paper and doesn't really becomes live. And then you need to have a framework that identify roles, identify what's the decision-making process, and identify what's the escalation path. If you got the people on board, then you can start focus on the process. Clearly, this is not a really, say, a strict sequence. It's rather than, let's say, a degree of importance overview. So you start with people, you go in process, so you start setting up the classical blueprint from Oliver Wyeth, for instance. You need to make sure that your framework is tailor-made to your own organization and to your industry. So it's not one fits all solution. You need to design this on your specificity. And what's most important, don't just stay and stop at the main, say, above the line process. You really need to understand what's a below the line process look like, which are the flows, and how to fix it. Because if you don't fix the foundation of your system, let's say the house will crash ultimately. And then I'll go to full financialization, which is the objective for today. And then a last overview on tools. We face it. This is a big headache for any organization, even mature organization. Master data, you got multiple platform. Normally you got an APS, which is different from ERP, which is different from your financial system, and they have to talk to each other. You need to find an idea like integrated dashboard or whatever the system allows you to make them talk to each other. Otherwise, you got data sitting in different systems which are disconnected. So this is really, let's say, the framework that I normally follow when we start a journey in implementing an IBP. Let me quick start with people, and then we go on the process, which is the core of today. People, as again, I said, they are the enabler. If you don't have a buy-in, as mentioned, you will fail in implementing a mature business. I just repeating myself of what I just mentioned earlier on, but that's very important. You need to have clear buy-in, clear identification roles, and clear identification of process. And finally, what I mentioned here, discipline in IBP participation. A mature IBP process is a process where the real decision, the real discussion, and it can be also confrontational discussion, happen in that session. In those sessions, don't happen elsewhere. If you do that support your decision making because decision happen there, action identified there, and action follow through on those very session. So you start laying the foundation for IBP or XP&A being the backbone of your business steering process. So that's where decision happen, and that's where the business starts to be steered. And the outcome is clearly a way stronger ownership of the plan and the action, and a visibility which is becoming longer and longer. And as we saw how volatile is the value chain right now, having a longer term visibility is very, very important. It's paramount to win on the markets today. That being said, let's focus now on the core of the presentation today, which is the roadmap. So I summarize here 5 main steps, and we'll go them one by one in the next few charts. But just to give you an overview, when you start the journey, the first thing to do is to map your process. Map your process because you need to understand what you're doing right now, and most importantly, when you implement a new framework, it's important to understand that few of the things you're doing now might be very valid and can be leveraged into the system. It's not that you need to trash everything you're doing today. You may have valuable process that need to be salvaged and integrated into the new framework. Once you do that, you start defining where you want to go. So you start defining your ambition. I mentioned earlier on that an IBP framework must be tailor-made to your reality, to your organization. That's where you start designing. So this is what we do today. This is where we want to go tomorrow. And then you basically have a starting point and your destination. And then you start basically drawing the path from going from today to your ambition. First step is to start planning the cadence integration, because remember, here we're talking about integrating IBP with financial planning. So ensuring that you got one work stream and not 2 separate work streams. Once you start reaching maturity in IBP implementation, you start planning the integration of finance, and we'll see how we do that. Then including your financial analysis, as I mentioned in your reviews, which means basically starting having financial consideration in your plan so that the decision you make don't have just an operational overview, but also have financial consideration included in them. And finally, and we see why we switch ownership to business, because normally, let me give a little bit of an overview here. Normally, IBP is considered like a supply chain board process. In few cases, finance driven, but mostly supply chain driven. Financial planning is clearly a financial owned process. If you want to design a process which is steering the whole business, you cannot be managed by only one of the functions which are involved. You need to have everybody involved at the same time. So you need to have IBP or XP&A owned by the business so that gives a sense of independence and facilitating the various business. It's like a referee of a match. You don't want to play for either team. You want to be the referee and be perceived as independent and supportive of all functions. Otherwise, some clashes may happen. We'll go more in detail in a minute. So this is the overview. Now we go step by step. So starting with step number 1, map the existing process. As mentioned, it's quite important because you want to understand what you're doing good already today and leverage on this process. So you start with I put very simple, as to demand, supply, and financial planning. You start with demand planning, see what your forecast process is already in place. You might be quite disconnected from finance. If not, congrats, you still got a mature process. But you need to understand which are the good part of your forecasting process, which you want to integrate in your demand planning process within IBP. Same thing for supply planning. Have a snapshot what is the as-is situation, what's your cadence, what's your discipline, which are the function involved, what's good in there, and how you want to integrate what's good in there into your journey for IBP. What I mentioned here, normally you will have limited visibility of financial impact. And when I say limited visibility, is mostly referring to focus on working capital. How much is your inventory in terms of volume and value? How it impacts your net working capital? In a mature organization, you start having choices based on what you produce, based on what's the impact also on profitability. And in no mature organization, this normally doesn't happen. And the third one, as mentioned, is the financial planning. You want to have what you process right now and making sure that it's connected with operational review or not, start working on this. So once you have a snapshot of your process, understanding what you want to salvage, you go to the next step. What just mentioned. So you got opportunities to leverage what's good. You start you defining your integration. So I put here 3 dimensions. First, what's your scope? So when I say what's your scope, I mean, you don't want to start by boiling the ocean or wanting to boil the ocean. You might want to start small, like a kind of an SNOP approach of an IBP, start with demand supply, and then extending to your product portfolio, to R&D, or even M&A, if that's um, your industry trend to grow by acquisition. Uh, what's the caveat here? If you start with a narrow scope, you got quick wins and you build credibility, you build momentum. Broader scopes, broader scope will align, will unlock full strategic alignment that we see. So it will comprehend the whole organization. So it's really based on your size, your industry, your maturity level. It's really a one by one case. Once you identify your scope, where you want to go, you start defining your horizon. As mentioned, normally organizations that start the journey have a shorter horizon. What IBP, the blueprint of IBP says you need to have a longer term horizon, 18, 24, 36 months. It's really depending on the industry. If you think of the extreme like aerospace have years of planning. Airbus, Boeing have years of planning. So it really depends on your industry. On average, 2 to 3 years is the standard. And that allows you to connect your starting short-term horizon with the mid and long-term strategic choices, which is normally what the financial planning supports. So if you start having your IBP having a longer horizon, you start having, let's say, overlapping of your horizon between your business supply chain operations and your financial operations. And that the decision quality, which is the critical add-on, the critical result of any strong and mature business. You need to define what's the right level of decision making. So IBP is a decision making framework, it's not a reporting framework, and understanding how much detail you want. You remember we were discussing that most of the people, most of the organizations, especially at the beginning of the journey, they spend way too much time in working on details of data rather than using this data available to make decisions. And that's exactly what I mean with my last point, aiming for decision-ready data and not perfect data. Because most of the time, data are not perfect because they're based on assumptions. So you need to stop going, good enough is good, 80-20 is good. Don't aim for perfection because it's quite impossible to achieve. Third point, the planning cadence integration. This is a quite dense. I apologize, but I could not find a better way to represent how you start to integrate the planning cadence of your IBP with your financial planning. First of all, when you start doing this, not right from normally you don't start right from the beginning, simply because when you start having your demand and supply rolling forecast, the plan that you start getting are way far from good because you need to work on data. That's basically you need to start working on how realistic are the plans at the beginning of the journey. Because there are many mistakes, we got master data issues most of the organization. You got system not talking to each other, so you need to run through cycle a few times in order to have a initially realistic plan. Once you achieve that, and you start building credibility on IBP generated plan, then you start thinking about how you want to integrate your IBP with your finance, and then becoming the backbone of financial planning, which means fundamentally finance will use IBP originated data for their own purposes. Let's assume now that we achieve a decent level of maturity and credibility. And I wanted to represent visually how this could look like. So let's say an IBP monthly cycle. That's your IBP monthly cycle. Every month you generate your plan, January, February, March. You got finance with us normally have a monthly rolling forecast because they want to really to look at their current month at the beginning of the month and the next month. So you got the same thing. Once you start achieving a good and sound, credible plan in IBP, IBP can start feeding the financial rolling forecast. So you don't have any longer two separate plans, but normally start from the same data because both go to salespeople and say, "Oh, what's your forecast for this month, next month, whatever," and then they start building up two different plans with the different. But on average, IBP is really a bottom-up exercise, so they start from a very granular level. Financial is more a top-down. They start from a much higher and less granular level. So it's always difficult to reconcile the two. That's why it's important that when you have a sound IBP plan, they can start feeding the finance forecast because then they start from the same level of granularity. Same thing happens for the quarterly outlook. So you got quarterly outlook from finance. They can feed from the relevant monthly cycle. Here I put January for Q1. It might really be that you use December for Q1. This is just an example. But just to tell you that when you start having the plan, which is sound, you can also feed the quarterly outlook. And then the most important output of a finance organization is your annual budget. And then you can start using few cycle. I put here September, October. It can be August. It can be December. It's clearly an example here to have the IBP cycle feeding the annual budget. Clearly, this is not a one-to-one relationship. It will offer the base, but then it's gonna be the sound base where then finance can start integrating financial consideration, which are normally not included in IBP. So if you do that, you start having a good sound integration of finance. What I'm talking here, though, is normally volume because IBP starts with volume. But then you need to start integrating in IBP also financial values. And when I say financial, it's mostly pricing to have a understand of revenue and cost to understand what's your impact on your profitability. So what I put here is if you look at the three main steps, three initial steps of a standard IBP process, you got the PMR, the DMR, the SMR. When you start to the product review, you normally look at new product introduction, what's your schedule, what's your volume. Then you start to not just consider the product by itself, but what's your target revenues, what are your costs, what are the expenses for advertising and marketing. So when you start introducing products and making changes to your portfolio, you need to start including your financial consideration and financial impact of doing so. So if you replace one product to each other, it's not just because it's more performing from a technical standpoint, but also because it delivers benefit to your bottom line. Same thing with demand. Demand normally starts at volume, but then you start to include in pricing, promotion, mix consideration, which is particularly important for most manufacturing organization. So you start understanding not just how your volume look like, but also how your revenues look like. Because that's clearly if you have a huge portfolio with different pricing points, that's so critical to include them because they will have a completely different impact on your top line and your bottom line. And finally, when we talk about supply, you need to start not just looking at your volume, like inches or kilos or liters, that you measure them. Also, what's your cost in terms of producing, it's variable and fixed. What's your impact on balance sheet and P&L, including provision, write-off, etc. So you have a full overview. What's your cost position when you start deploying your manufacturing plan? So if you do that, you will have every single operational scenario translating into profitability, into marginality, and into cash position. And the last point of the roadmap, switching ownership to business. So I mentioned in my intro, it's important that the business might be the leadership of your commercial unit, your regional unit, depending how you structure, has the ownership of the IBP, because then finance and supply chain, which normally where XP&A and IBP start, can start providing the case of finance, financial data for scenarios and operational feasibility of a supply chain. But at the end, it's the business which is accountable for making decision, uh, understanding which are a trade-off between function and driving execution. And this is why it's very important that you start planning for the transition from supply chain of finance where you start to the business ultimately. This is, I don't see questions, so I'll go on. Any question, put in the panel. So if you follow this roadmap, you ended up having what I call one set of plans. You normally hear about one set of numbers. In reality, when you say one set of numbers, you might think one plan. And as we see, as we saw all the disruption where we see, you might have different plans. What's important that they plan talk to each other. So I'll try to make a visual example how in a standard IBP cycle, how a plan gets evolved and gets changed. What is important to keep track of your plans that go through one single monthly cycle. So starting with the demand review. So the unconstrained plan, having the signal of a market. You start with the base plan. What I know I will sell to my customers. But that's normally we add vulnerabilities. We say we got something we want to include the plan, but there's a minor risk that may not happen or might be delayed. We don't think it's going to happen, but there's a risk. So we signal this. And that's what basically is the firm plan, which is what we know we're going to sell and we most probably going to sell. And then you add opportunities. Opportunities is what we don't think we're gonna sell today, but there's opportunity with the customer, which is not signed yet or is not agreed yet, but that's work in progress. And we need to keep track of that. That makes you a total plan. Why you do this? Because you want to ensure transparent discussion on the risks and opportunity impacting your demand. Normally, what organizations take, although is a firm plan because opportunities still way to go. They don't gonna happen short term. So we park for a moment. It's important to keep track of them, but we're gonna focus on the firm plan. The firm plan will feed the supply review, which then will actually subtract from a firm plan the constraints. We got this issue with the line, this issue with the raw material. We cannot produce the entirety of the firm plan. So there are some constraints that needs to be taken off. And what we are able to deliver is a constraint plan. Oh, sorry. This is important because it ensures transparency on the operational reality. So we know our market demands 100, but we're only able to deliver 90. So we got 10 of constraints. It's important to consider this 10 because we not be able in this cycle to deliver the 100 that the market asks us. So the constraint plan is really what feeds then the financial reconciliation. It gets monetized, and then you got your financial plan. So you saw we started with the base plan and we ended up with financial plan. In general, in overview, we got multiple plans which are interconnected. It's okay to have them as long as you can go from one plan to the other. So you don't have one set of numbers, you got multiple set of numbers, but it's important they are coordinated and connected. You do this in a mature way, you're able to build what's the best practice called the bridge between planning and finance, which I try to represent here. You start by capturing the external signal from the market, so the market demand, the unconstrained demand. What's the opportunity on the market? What your customer will require you to sell. You start having some commercial intelligence, so understanding this is a risk, this is an opportunity not really secured yet. So let's quantify what's the uncertainty on the plan. Let's set the execution realism, as I mentioned here, what we are really able to produce. Let's make sure that all these plans are financialized. So we include all the financial assumptions on this, and we end up having a consensus forecast, which is monetized. That's your final agreed monetized plan. That's really the bridge from understanding what the market asks you through a series of reviews and assumptions that are tracked, measurable, and agreed until your end plan. So this is really a snapshot of what good look like in an integrated planning framework. You do this, what's your expected result and impact? I summarize them across 3 dimensions. Clearly, this is an average of what organization can expect to get from a mature business. It changes from chance to chance to from case to case, but that's a good summary. So from a governance standpoint, you have one backbone, one identified structure where you take decision and discussion that happen all over the place, as normally no mature organization do. You got a given forum where you got your discussion, your decision, your action tracked, and it's clearly traceable and measurable. You got clear accountability, and you got financially fully embedded, so you don't have multiple work stream. In terms of performance, you got more resilience to disruption because you start having, as we saw from the bridge, a good overview of what are the market and the challenges, and you start delivering and having multiple plans that facilitate your scenario planning. That will allow you to ideally share gain and have margin improvement because you, through increased discipline, you're able to secure more opportunities, having so improving on your marginality and your cash position. And then having more faster strategic execution because once you put operational reality into that, you know what you're really able to produce and you can take decision who to serve based on that. And finally, in terms of process, ideally you have an improvement in bias and accuracy, a continuous alignment of the plans, well set of plans, which I mentioned, and then the scenario planning that allow you to assess your risk opportunities before taking decisions. So being more proactive and less reactive than in the past. I want to take one last point because the next trend in IBP is really becoming the strategy backbone. So normally every single corporate, especially large organization, have their own strategy process. And IBP start to be the starting point, the first stepping stone of your corporate strategy because it's deployed normally at organizational unit, commercial unit, business unit, region, whatever it's your organization is set up as, and is the engine where strategy gets asked on a daily basis, on a monthly basis. That feed your organizational unit strategy, your business unit, region, your commercial unit, that will develop the longer, like mostly 5 years time, strategic map priorities. So IBP is really the backbone because it normally represents the first 2 years of a longer term strategy, and your operational unit strategy will feed your corporate strategy, which is really your long-term vision of the organization, where you want to be, what's your outbound strategy, to return from the street, from the markets. So if you start having a very mature business, it really goes into the stepping stone of your corporate strategy. And that's basically summarize what I just mentioned. So translate the corporate ambition into executable plans. So that not the strategy stays something on paper, it doesn't get live, it gets through the execution through the IBP session. And here I'm basically closing. Key takeaways from the presentation was helpful. So that's what okay, it's not a process, it's a shift. Go to the point that people are the key enablers of a good IBP or XP&A framework. If you have this mind shift, it becomes an exercise on paper, it doesn't become live. Finance and supply chain must start speaking the same language or said in a different way, they start to pursue the same objectives, the same KPIs. It's not that it got clash between what finance was to achieve, and supply chain was to achieve. How you do it is start small, as we mentioned, do quick win, and then you start scaling as fast as your industry allows you. Ownership drives impact. That's why I want to have business ultimately owning BP and having IBP at a certain maturity, the bridge between strategy and execution. So if you do that, you basically go from a disconnect starting point to internet starting point the value delivered. With that, we got 45 minutes down the road, open for any questions that you may have. You got the Q&A button at the bottom of your Zoom window, so feel free to ask questions. Sushma, can you help me also with that? Because I don't see any questions at the moment.
Yes, we have not received any questions yet. I request everyone, if you have any question, please ask. I think I have got
Uh,
one.
that that's a good one. Yeah, the trends on AI. I quickly mentioned that there are a few trends now. Let's say the one that I see um, most current is the AI agents that help in several areas. The two areas which I mostly saw is uh, master data optimization. You normally have clashes of master data, so GenAI can understand which are the flaws in how master data are recorded, flag them, and allow you to get a let's say, more consistent way of data coding. Secondly, on forecast. It started already with machine learning, but now AI is very good in detecting on your statistical forecast what are the major deviation, highlight them, and then allow your demand managers, demand planners to focus on really the main deviation. So there are many more also on the supply side, on procurement side, but let's say these two are the ones that really are currently impacting. Okay, second question is IBP is about strategy deployment. Strategy long-term plans as a key. Yeah, that's a good one. Normally, I didn't mention that's a good point. I didn't mention normally if you have a mature setup, you want to ensure that IBP and the strategy talk to each other, which means that normally the standard IBP. Let me go back to the finance one, just probably it's clearer. Bear with me. Yeah, no, many charts. Okay, here. Um, Normally, IBP has a horizon on 2 years, and they feed the strategy review. Doesn't mean that the strategy review blindly takes the IBP, but it's a backbone. Then strategy has over considerations in here in when it's deployed, when they send the longer term trend, then they feed back to IBP. So normally the IBP, the following IBP session integrate, especially on long term, let's say 12 months out or 18 months out, the inputs in terms of lead time, in terms of leading indicators, what's coming from a strategy integration. So it's a two-way communication between the two. You make sure that IBP supports the definition of a strategy review, and the strategy is defined normally once a year. They got fed back into the IBP sequence cycles, especially for a longer term. Third question is about budget. Tends to budget on year growth. Yeah, that's a critical point. That's what happened mostly in the demand reviews. So what you're saying is basically there's a tendency to have a budget of showing growth. So, and that's not really reflecting to real, foundational IBP because you might not see that growth on the market. How you reconcile the two? What's a critical discussion happening in the DMR and the MBR. So you got a budget of 100, but your plans show you they can only achieve 80 or 90, whatever. So you got a gap of 10 or 20. That's where most of the discussion in the DMR happen, how to bridge or at least mitigate the gap. What action you can put in place, if any, to ensure that you can reduce the gap versus your budget. If you remember when we saw the various points, one of the areas was the opportunities. Opportunities, that's when they come to play. We got opportunities. I saw organizations saying what should we put in place in order for these opportunities to become real? In some instances, you got opportunities that can bridge the gap. In other instances, you got opportunities that don't bridge or to not fully bridge the gap. So that's where you need to start communicating to the MBR. Look, we got an issue here. We cannot make it to the budget. And what I saw also happening in my experience, for instance, DuPont and AXO is other business unit are requested to go the extra mile to compensate for business unit which for whatever reason, industry trend or macroeconomic condition cannot achieve the budget. But to your point, formally is that's where the discussion happens. You got the budget 100, you got a plan, or say a bottom-up plan, which is 80 or 90, how we manage to mitigate this 10 or 20 of delta. Sometimes you got opportunities to do so, sometimes you don't. Similarities, difference, have you seen clients, different industry and sectors? Oh, that's a huge one. It really that there are say the structure is fundamentally the same. The big difference is about time horizon. So if you look at also minor aerospace companies, they always look at longer term. They fundamentally don't have a demand review because if you think at Airbus, I've been talking with some people at Airbus, they got the pipeline filled for a foreseeable future. So they don't even look at demand. And that's one of the things that is normally unusual. And they look at 10 years out, at least 10 years out. Most of the cases, what really different is the industry dynamic, how much you can basically collect information on the demand and how impact you have on your markets. But in general, I see very few differences. Another factor of difference is how regulated is your industry. So if you take life science or healthcare, is highly regulated. So the path you can replace your portfolio and capture new market is way smaller, way slower than standard manufacturing business. So it really depends on the industry. Not sure if I address you. It's a huge question. It's very difficult to make a summary because industry is so different that you don't have one fits all. As I also mentioned, you cannot have a one fits all blueprint that works for everybody.
Do we have any other questions? Mazimo, can we wait for a minute, please? So that
Yeah,
if
sure.
anyone would
And
like to ask any question. So if you
and
have
that's
any
not
questions, please ask your questions. Mazimo is here to answer those questions.
and as mentioned at the beginning, if you have questions coming up after the session, feel free to send up and we'll address offline.
Yeah, if you have any questions, we still have time to answer those questions. If we have, yeah, I think we have got one. We have got one.
That's a good one. How to introduce IBP to the executive committee? Well, let's say this very senior leadership normally like to have stories and solutions. Let me put in a very blunt way. So you need to position IBP in order as a solution to address one of the existing issue. That's the only way that you can raise the interest of the executive committee because it's an investment. It's an investment in terms of time of your organization. So it's a cost and it will change the way you work. So it needs to be there in order to address one of the issues. So yeah, imagine that you want to introduce IBP because you see some flaws in the process and probably inability to capture business. Normally, that's what the senior leadership is interested in is improving your bottom line and increasing your top line. So if your current planning framework or whatever doesn't allow you to be as reactive as you want, that's where you want to have an IBP introduced. So you need to build a story and need to study. If you do this, this is the expected investment. This is the timing trajectory, and this is what you expect to deliver. So you need to be very specific. But again, you need to present a solution to an issue. Don't just sell IBP for the sake of selling IBP, because normally it never works.
If you have any more questions, please ask. We still have few minutes, so you can ask questions. I think there are no questions anymore. So we will wrap this up now. Thank you, Massimo, for this amazing presentation. And I'm sure all the attendees would have learned a lot from this presentation. Thank you so much, you all, for joining this webinar today. And I hope you found the shared information useful and insightful. Remember to apply the knowledge gained in your work and share it with others. The webinar recording will be shared with you and uploaded to our ASCI YouTube channel in a few days. Don't forget to check out our website for more resources and upcoming events. Have a nice day. Thank you so much for joining us today. And thank you so much, Massimo, for this amazing presentation and for your time today.
Thank you. Thank you, everybody. Thank you for the opportunity. Have a good evening, everybody. Thank you for being here.
I guess I'm so sorry. Okay. No
No,
questions. Thank you so much, everybody. Thanks, Simon. Thank you, everyone. Have a
thank
good
you.
one. Bye.
Thank you. Bye.